This is Mike Sullivan. I'm a former IRS agent, teaching instructor with the Internal Revenue Service. Welcome to my YouTube station. Today I'm continuing the series and I'm doing page 4 of the 433A. I'm doing a deep dive into that. So anyway, I worked at IRS for a decade. I've been in private practice for 4 decades. I have been doing this 50 years. I am a national expert in IRS resolution matters. You can see me in a tie and all my video. I'm on national TV a lot. You can see all those videos, some of them anyway. I didn't post them all at 777irs.com. And you can see my team of IRS national experts really on that site. So I've been trying to do a series on the 433A. Today I'm going to end that with page 4. Page 4 is going to come as a bit of a shock really for most people, but if you're going to watch page 4, you should watch page 1, page 2, page 3. You know, I try to do these really within 5 minutes so you don't get really bored. So as a former revenue officer, I've probably filled out thousands of these forms. There's probably been 10 or 12 generations of the 433A. Just remember the 433F is used by the service center if you're calling IRS. The 433 AOIC is used by the offer and compromise. The 433 is used by revenue officers, but it's a great teaching tool. And that's what I want to do today. Is I want to teach you what IRS is looking for. So you should right now be pulling up the IRS form 433A, and hit page 4. It's the 433A, page 4. I'll take a little break, a 3-second break. Blah, 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 blah. Okay, now you're back. So let's look at page 3 on the finance. This is really a killer for most people. It really is. You're going to find out how IRS determines whether you're uncollectible, going to be in a payment agreement, and actually qualify for an offer. So let's go back and understand IRS collections at 30,000 feet. 30,000 feet, IRS just cares about 2 things. IRS cares only about your assets or your income and expense ratio. That's all they care about. We've already covered the asset part of this, and now we're going back to look at the income and expense ratio to find out. Many people don't know, but IRS only allows you to live on X amount of dollars. So what does IRS do? They've gone to the Department of Labor and they find out what costs are, what it costs for you to live in a certain county really in the United States. So what you're going to want to do after this is you're going to want to go Google IRS national expenses for food and clothing, IRS national expenses for housing and utilities, IRS national expenses for vehicle ownership costs, IRS national expenses for operating costs. IRS is going to fix the amount of expenses that you have in these categories. So let's go to the 433A, page 4, and let's look at that. And you're going to see that you're going to put your gross monthly income on the left. Now, there's a good question. What period of time do you want to use? Well, you can use 3 months, 6 months, 9 months, or a year. If I'm reporting to IRS and you don't want to pay or you're in a hole, you want to use the worst period of time. But they've got to be consistent months. So if the last 3 months was the worst time, use that. If the last 6 months were the worst, use that. If the last 9 months were the worst, use that. You really want to generally use the worst period of time. Here's where the problem is. Let's say you're a real estate agent, okay? And let's say 2 months ago, all of a sudden, 2 months ago, you go ahead and you just have a real estate commission for $50,000. Well, that could throw the numbers off. So you may want to go back a year or 9 months. You can play with those numbers, but you want to at least be fairly accurate with IRS because they are going to ask, and they're going to want bank statements, pay stubs, and they're going to want to know what you want. So that covers the income side. You've got to go ahead and put your K-1 if you have a company, if you're getting any spousal support or Social Security or alimony, you got to list that as income. But remember, I would use the worst period of time that you can, either 3 months, 6 months, or 9 months. But be accurate. Let's look at the expense side, and here is where it really gets funky. You are going to put your actual monthly figures in there. You know what IRS is going to do? IRS for line item 35, 36, 37, 38 are going to go ahead and say no. You can put yours down, but the IRS use only allowable expenses, we're going to use the national standard. The IRS, once again, national standard, you can find at, just Google IRS national standards for food and clothing, housing and utilities, vehicle ownership, and vehicle operating. You will see what IRS allows you to live. And it's usually region by region. For food, housing, and utilities, it's by county. The IRS uses the Department of Labor to go ahead and come up with these figures. IRS will then allow whatever you spend for health insurance, out-of-pocket care, court-ordered payments, student loans, child and dependent care, life insurance. You got to put your estimate or withholding taxes in there. IRS will allow everything else dollar for dollar. But this trips up everybody because no one lives into these IRS national standards. Now, there's some ways to get around them I'm not going to talk to you about. That's for my use only, and that's why we're so good. But anyway, I just want to give you a good, a big heads up that the IRS national standards controls these total living expenses. You need me, you know where to get a hold of me. I hope this series was good for you. I've explained the 433A, page 1, 2, 3, 4. Just remember, IRS allows all the medical you want. IRS allows all the prescriptions you want and all that. They just limit your food and clothing, house and utilities, vehicle operating, and vehicle ownership costs. Thank you for listening. I really need subscriptions. It helps me move up on YouTube. Thank you very much.